Welcome back. Now, at the full year mark, Nedbank CEO Mike Brown is leaving the group with an 11% rise in revenue driven by cost management measures. This helped offset a 30% jump in impairment charge. The credit loss ratio has improved. Headline earnings per share in the meantime grew by 15%. And at this point, all the group's post-COVID targets first announced 2 years ago have now been met. Shareholders also reaped the benefit with a final dividend increase of 18% dividend. And joining us with a closer assessment of the numbers in this song is company CEO Mike Brown. Thank you so much for your time, Mike. Now, let's actually start off with the kind of double-edged sword that a higher interest rate environment provides. Would you say that it's skewed more towards the benefits rather than the challenges for Nedbank?
Yeah, thanks. It is very much a double-edged sword, and it's quite hard to work out exactly the pluses and minuses. Clearly, when interest rates go up, banks earn more money on their own capital, and we call that endowment, so that does give us a benefit. But generally speaking, when interest rates go up, what we know is 12 to 18 months later, retail bad debts will go up, and that will eat into some of that endowment benefit. But also, when interest rates go up, the economy grows slower than it otherwise would have. Loans and advances grow slower than they otherwise would have. And generally speaking, one of the reasons interest rates go up is because inflation has gone up, which means expenses are higher than they otherwise would have been. So it's quite difficult to work out exactly is there a net plus or a net minus. And really what we do at Nedbank is try and manage that through cycles so that over time, rising interest rates gives us more endowment income, and we give some of that away in bad debts.
Yeah. Well, let's actually talk about your credit impairments. There was an increase there of 30% down from the 57% increase that we saw in the interim period. In what context should we be viewing this movement?
Well, I think you always have to look at a bank's results in the context of the economies where it's operating. And you know, we are predominantly in South Africa. We've got businesses outside South Africa too, but the South African economy has been growing very slowly. I think somewhere, 0.5% or 0.6, I think was the number that's just come out this morning for the full year last year. And interest rates have been going up and inflation's been going up. So that puts pressure on consumers. And as a consequence of that, we've seen what I would call a cyclical increase in bad debts. Predominantly in the first half of last year, as you said, up 57%, and then over the full year, up by a smaller amount. What we look at is something called a credit loss ratio. For every 100 Rand you lend out, what are you losing in bad debts? And in the first half of the year, it was 1.21 Rand. In the second half of the year, it improved to 96 cents. And over the full year, that was 109 cents. That's still higher than we would like it to be, but we would expect it to come below 100 cents in the Rand during the course of 2024.
All right. Let's actually look at those dynamics in terms of credit demand, what you've seen in the different areas. Are there any trends that stood out for you in terms of demand from consumers versus corporates?
I think the big picture would be that in a rising interest rate environment like we saw during the course of 2023, generally speaking, consumers' demand for credit reduces. That is the monetary policy transmission mechanism into an economy to ensure that inflation reduces over time. And we started to see that reduction in inflation coming through. So we've seen a slowdown in consumer appetite for credit, less credit applications. And I think that will remain sluggish into the first half of 2024, with perhaps some increases in the second half, because we do think that interest rates will begin to reduce. And then on the wholesale side, again, we've seen relatively slow demand for new credit, other than in some areas of corporate finance activity, one business buying another, etc. But very, very strong demand for private sector renewable energy generation. And Nedbank has been a market leader in that environment, and we've got very strong lending pipelines to support overall balance sheet growth in an otherwise sluggish economy.
Well, talking about pipelines, you did achieve your post-COVID targets for 2023, and now you talk about a shifting focus to your medium-term targets. Where are you seeing more room for growth still in a subdued economic environment?
So, I think the big picture for us is is while we think 2024 will still be difficult in the economic environment, we do expect it to be slightly better than 2023. I think GDP growth will be slightly higher in 2024 than it was in 2023. And as I said earlier, we think by the time you get into the second half of 2024, we should start to see interest rate reductions. So while it will be difficult, we should get some environmental help into 2024. And then really at Nedbank, we've been very focused in particular on our digital journey, and we've completely refreshed the Nedbank technology stack. As a result of that, we've seen 9% growth in main bank customers in our retail business, 16% growth in Money App users, and we are now joint number one on Net Promoter Score in retail banking. So that should continue to support growth. In addition, in retail banking, we would expect bad debts in 2024 to be high, but lower than 2023. That will also support growth. And then finally, within our CIB businesses, as I said, we think that strong growth vector of renewable energy is a multi-year growth opportunity for Nedbank.
Now, Mike, as we wrap up the interview, of course, this is your last results interview before you retire in May after 14 years as CEO of Nedbank. What would give you hope in terms of the economic environment that would help consumers and businesses to thrive?
Well, I think, if I think about where business has gone with our conversations, is that, in short, our economy is growing too slowly. South Africa has a growth problem, and our economy is growing at, maybe just less than 1% in 2023, maybe just more than 1% in 2024. But fundamental to that growth problem has been the collapse in public sector infrastructure that businesses need to be able to survive and grow. And we've seen that in energy and load shedding, and we see that in logistics. And those together probably contribute more than 3% of GDP growth that we're losing because of those problems. And for consumers, and indeed for our government, economy that's growing at 3 or 4% is materially different to an economy that's growing at 1%. So absolutely vital is ensuring that we resolve energy and load shedding and logistical constraints.
All right. Well, thank you so much for your time and giving us insights on Nedbank's latest results. That was Nedbank's outgoing CEO, Mike Brown.